Most conversations about stablecoins revolve around USDT or USDC, the largest players today. But they're not where stablecoins started. Long before dollar-pegged tokens arrived on blockchains, people were already trying to build digital money that could move value quickly online. Our journey begins in the 1990s with David Chaum's DigiCash. It wasn't a stablecoin in the modern sense. There wasn't a blockchain or token peg, but it carried the same DNA. The idea was called eCash, digital money that banks blind-signed, then locally stored on your computer, ready to be used. In 1995, Mark Twain Bank in the US began issuing these digital dollars, and soon giants like Deutsche Bank were running their own pilot trials. To a user in 1996, it felt like magic. You could click a button and send a private digital payment, closer to handing someone a banknote than swiping a credit card. But the world wasn't quite ready. The internet wasn't built for seamless payment yet, and convincing merchants to overhaul their systems for it was a losing battle. By 1998, DigiCash was bankrupt. It had proven that digital money was possible, but it also showed that even good ideas can fail if friction was too high. While DigiCash struggled, a project called eGold launched in 1996. Unlike DigiCash, eGold didn't wait for the banks and merchants to innovate. It was a private internet-native currency that allowed users to trade digital units backed by physical gold bars held in a vault. It exploded in popularity, but was ultimately shut down by the US government in 2008 due to concerns over money laundering and illicit use. Still, eGold had shown that people were willing to hold and transfer value entirely online, outside traditional banking rails. As the internet became a bigger part of everyday life in the 2000s, experiments with digital money persisted, sometimes in very questionable ways. Liberty Reserve is one of the stranger, darker chapters of this era. Launched in 2001 and operating out of Costa Rica, it acted as a sort of digital shadow bank for the world. To use it, you didn't deal with the company directly. Instead, you relied on independent exchangers who would take in cash or wire transfers, then credit your Liberty Reserve account in return. It operated outside traditional banking oversight and allowed users to transfer value across borders quickly. Naturally, it became a hub for the lawless corners of the early web. It eventually collapsed from a global coordinated takedown in May 2013. The closest ancestor to modern stablecoins, however, is a project called BitShares. In 2013, before Tether launched, BitShares introduced BitUSD. Unlike earlier experiments that still relied on external financial rails, BitUSD was designed to live entirely inside a blockchain. It used its native BTS token as digital collateral to support its peg to the US dollar. While several shortcomings prevented it from gaining traction, it was essentially the first crypto-native attempt to build its own version of stability from the inside out. Then Tether arrived, and it had a simple promise. For every digital token issued, it would be backed by matching fiat reserves. By 2014, the crypto market had become a wild 24/7 arena, and traders were facing a practical nightmare. Moving money back into a traditional bank account was slow, expensive, and often took days. Traders needed a waiting room, a place to park value during a storm without actually leaving the digital world. Tether provided that anchor. And after that, competitors kept coming, up till today. You could convert a volatile cryptocurrency into a stable one instantly. Initially a tool for traders, but has since evolved into a broader layer for payments, savings, and settlements. But what if stablecoins never emerged? Could Bitcoin have actually worked as everyday money?